Hi guys, welcome back to the June update of my dividend growth portfolio. In this portfolio, I currently have 120,000 euros split between 19 stocks and 3 ETFs. But over the course of the next decade or two, I want to grow it to over 1 million euros. And I want to generate a nice and steady stream of passive income along the way. Today's episode will be a bit of a special episode, because I've been sharing and updating my portfolio here on YouTube for over 6 months now, and I want to take a step back and share what I've learned as a new YouTube investor. Plus, as promised, I will share and go over my current watchlist today. And if you're new here, my name is Florian. Thank you for joining me today. By the beginning of June, my portfolio was at 190,692 euros. By the end of the month, this had grown to 120,825 euros. My ETFs grew by 3.08%, while my stocks did actually underperform my ETFs with 2.5%. This comes after several months of outperformance of my stocks against my ETFs as well as the S&P. But we can't win every month, right? Plus, this is a new end of the month record for me, so I am actually pretty happy. The strong performance of my ETFs mostly came from the S&P 500 that did grow by 3.9% in the last month alone. My emerging market ETF also had quite a good performance with 3.5% and has reached the highest levels since early 2022. And while this is nice to see, this ETF has basically only moved sideways since 2027. So in the short run, I am not overly optimistic that it can break out of this now. What is a bit surprising though is that my cybersecurity ETF also vastly underperformed the market last month. And speaking of the market, the S&P did grow by 4.5% last month, the MSCI World by 3.8%, while the Nasdaq, here the QQQ, had the best performance with 5.5% returns in 1 month alone. The Eurostoxx 600 did even go down with minus 1.3%. And if you're wondering why my S&P 500 ETF did perform quite a bit worse than the original index, the reason is that I am investing in euro, so I have some currency effects in my portfolio. And with the euro being pretty strong right now, the value of my US stocks and ETFs is impacted by this. But honestly, I do not watch the exchange rate very closely, and it also does not affect my investment decisions. The reason is that I am investing mostly in global companies that also generate their income around the world. So they also have exchange rate impacts in their returns. And if I buy new stocks, I do get more stocks for the euros at the moment. So overall, these effects balance each other out, especially when viewed over the long run. But on the short run, it is still noticeable. And this is already the first effect that I noticed since posting my portfolio here on YouTube. Because before that, I actually never compared my portfolio to these indices on such a regular level. So I never actually noticed these exchange rate effects before. I mean, it is interesting to see for sure, but it doesn't change anything in my investment strategy or in my investment decisions. But with this strong performance of US stocks, some of the US indices also pulled ahead of the Eurostoxx 600 for the first time this year. The strong performance was driven by the whole market and across all industry. While the healthcare sector was still under quite some pressure last month, this month pretty much the whole market, except some individual exceptions, is green. And it has also pushed the S&P 500 to new all-time highs. And this comes at a time where the pause of Trump's tariffs is coming to an end. His deadline for restarting the tariffs he announced on his Liberation Day in April is ending next week on the 9th of July. And the optimism in the markets come from some White House remarks that the deadline is not critical and might be extended. So let's see what happens next week. My guess is that the taco trade will still prevail and that Trump will further shift the deadline. But for me as a long-term investor, this is all noise in the market, and I believe that by autumn or maybe latest end of the year, we will be back to normal again regardless of what happens next week. I mean, at least as normal as it can get with Trump as the US president. But still, last month I didn't buy any new stocks. Yes, you heard right. No stocks at all. Nothing. But the very simple reason for this is that I was on business trips and trade shows for the whole month. So I simply didn't have any time to check stocks or decide on any investments. And this is actually another point of being a YouTube investor, which I really started to consciously notice last month. I do feel some pressure of showing you guys something new and exciting every month, and even feel a bit guilty if I can't do that. But this is not how long-term investing actually works. At least for me, it's not about trading the most exciting stocks or participating in the latest hype trends. For me, it's all about rationality and persistence. Or to put it bluntly, for me it's a marathon, not a sprint. But since I started sharing my portfolio here, I caught myself sometimes stressing out about things that should be trivial, like the monthly performance of my portfolio or not buying stocks every month. It is actually pretty interesting to observe my own behavior and my own reaction in this way, at least when I noticed what I'm doing and where my thoughts are coming from. More often than not, this probably goes under the radar though. So I will try more actively to scrutinize my decisions also from this point of view. I am still pretty happy that I started this because it helps me to better understand my own motivations and reasons behind some of my decisions. And in the end, this hopefully makes me a better investor. And speaking of motivations, one huge motivation for me is to see my dividend income rising steadily. And last month, I received 4 dividend payments. The first one was from Visa on the 3rd of June, who paid me €9.81. Then came S&P Global on the 12th with €9.91. Microsoft followed on the next day with €15.11 and Next Era Energy on the 19th of June with €32.45. So in total, I got €67.28 in dividends last month. This has brought the overall dividends in the last quarter to just shy of €600, my best quarter so far. And of course, as always, I will reinvest everything back into my stocks. But without any new buys last month, my portfolio allocation also did not change very much. It still basically looks the same as last month. A couple of weeks ago, I promised you to show you my latest watch list. So let's switch gears for a moment and have a look at the latest companies I have on here and my investment thesis for them. And because we have many companies to cover, I will split this between this episode, where I show you the companies from the industrial, construction, finance and consumer sector. In my next portfolio update, I will go over the healthcare, tech, semiconductor and resource sector. But before we go there, if you like the video so far, it would make my day if you hit the like button and subscribe to the channel. I know it's a bit annoying to ask, but it really makes a difference. So thank you very much. And the first company I have on my watch list is already pretty exciting. It is the rather unknown Norwegian company Tomra Systems. They are the global leader in recycling and sorting technology. Those reverse vending machines and high-tech sorters that you see at supermarkets and recycling plants. The company plays a big role in the circular economy and sustainability space, which is a growing global trend. They operate in over 100 countries and are well positioned for long-term growth with several secular trends in their backs. This stock has been going sideways since early 2020 though, because they were struggling from rising interest rates and cost inflation that put some pressure on their margins, as well as a cyber attack that hit them hard. But recently, the demand for sorting machines seems to bounce back, with several European countries implementing new regulations. I have them on my watch list for around 2 years now, because I find their business and their strong market position very interesting. But because of the problems they were facing, I have not bought into them yet. Next on my list is Schneider Electric. And you might notice the small yellow flag here. This basically means that I'm currently only observing this company but have no real intention of buying it right now. Schneider Electric is a French company specializing in energy management, automation and digital infrastructure. Think of them as the behind-the-scenes powerhouse building the smart grids, breakers, data center power systems and automation tools that enables electrification and sustainability. They operate in over 100 countries and, like Tomra, also ride big secular tailwinds: AI-driven data center demand, renewable energy and efficient building control systems. The stock has had relatively stable growth over the past 2 years, up to low single digits, thanks to steady revenue growth in energy management and digitalization. But it has been held back at times by industrial automation softness and a cautious macro sentiment. I have made a full analysis of them last September that is still fairly up to date. I will put a link to it down in the description if you want to check it out. The reason why I have the yellow marker here is that I am already secretly invested in Siemens. And by secretly, I mean that it is not part of my dividend growth portfolio that I share here on YouTube. Siemens is actually the first stock that I ever bought, and I own it for over 20 years already. It is actually one of the key reasons why I focus on dividend growth stocks. Because at this point, the annual dividends I receive are more than 20% from my initial investment. I've been thinking about telling the history and story behind this investment on the channel. So if this is something that you would like to hear, please let me know down in the comments. The next company on my watch list is Linde. Linde is a well-known global heavyweight in industrial and medical gases like oxygen, nitrogen, hydrogen, and specialty gases, powering everything from hospitals to semiconductor fabs. They are also big on engineering custom gas plants and hydrogen infrastructure, riding trends like decarbonization, hydrogen economy, and steady industrial demand. The stock trades at around $475 as of right now, up roughly 11% over the past year and about 33% over 2 years. As one of the key players in this industry, their diversification helps them to produce a steady performance with resilient cash flows. They are also one of the longest companies that I already have on my watchlist, but I always found them a bit too expensive. But unfortunately, they also never seem to be getting any cheaper. The fourth company on my watchlist, but also one with a flag, is the first US company I have on here, John Deere or Deere & Company. They are also a global leader, this time in agricultural, construction and forestry equipment. They build the tractors, combines, harvesters and turf equipment that powers farm and work sites worldwide. I will not waste too much time here because you probably know them already. What I like about them is their focus on innovation like AI-based spraying, telematics, autonomous driving and even software, which taps into all the latest trends in automation and sustainable farming. They are also growing their dividends with a double-digit growth rates for decades already. But what I don't like too much is the very cyclical nature of their business. And after very strong years in 2022 and 2023, we are seeing a decline in revenues right now. And while it is true that it's best to buy cyclical companies in their down cycle, I think that this one has just started. Next on my list, we have the last industrial company. It's the Italian super compounder and one of my top 2 stocks on my watchlist right now, Prysmian. They are the world's largest cable manufacturer, producing energy and telecom cables, including submarine power links and fiber optic systems for wind farms and data centers. With these products, they are riding trends in electrical grid upgrades, renewable energy infrastructure, and AI-led data center expansion. The stock currently trades at around €59 at what I find a reasonable valuation. Unfortunately, I missed picking them up in April. But after I started my position in TSMC back then, I just didn't have any money left over for them. The capex-heavy business is also affected by cost inflation and macro uncertainty, which I believe currently puts a cap on the upside of the stock. But long-term investors do get a market leader here that is working in several industries with secular tailwinds. I will definitely pick up the company if it falls below €53. But even if it doesn't, they still have a top spot on my watchlist together with a healthcare company that I will show you next time. Next on the list is the US construction company Sterling Infrastructure. I made a video about them on the 4th of January last year. Since then, the stock has risen by around 200%. Sterling is a US-based infrastructure service firm specializing in e-infrastructure like data centers and manufacturing sites, transportation such as highways, bridges and airports, and building solutions like concrete foundations, plumbing or slabs. Since 2017, Sterling shifted from heavy civil work to higher margin, mission-critical projects, growing their revenue to over $2 billion and boosting margins from 4% to 20%. Since the beginning of the year, the stock is up by more than 30%, which handily beats the broader market. When I first analyzed them, I found them pretty cheap, but was concerned about the cyclical business and the rising competition. The cheap valuation we had back then is gone now, but the risks still exist. So I am afraid that this stock, even though it is operating in margins with tailwinds, might be a bit overhyped right now. And this brings me to my only financial stock on my watch list. One that I only found through your recommendations. It is the UK-based Ashtead Group that is also listed in the FTSE 100. This industrial equipment rental company is operating under the Sunbelt Rentals brand, primarily in the US, Canada and the UK. They rent out all kinds of machines and essential tools across construction, industrial and the event sector. Currently, they benefit from a shift to rentals over ownership and the US infrastructure spending trends. Over the past year, their price is down by over 10% due to pressure of increased interest rates, which has forced them to lower their guidance. But their Sunbelt 4.0 program and the planned listing in New York next year could change this soon. I have a pretty recent video where I talk about AHD on the channel, which I'll also put in the description below. Next on my list is another UK-based company, Games Workshop. They produce tabletop games and are best known for the miniature war games such as the Warhammer 40k franchise. They are the kings when it comes to building a community around their games, which they distribute through their own stores worldwide. Over the last year, the stock climbed by 50%, which makes them pretty expensive right now. But the Warhammer universe is becoming more and more popular in the mainstream through a lot of video games and an Amazon series that is currently in the making with Henry Cavill. This is of course a chance as well as a risk depending on how the fans will like it. And my investment thesis on them is also a bit speculative. Because with the 40k universe being so deep, with such detailed lore and countless books, I think that there is a small chance to start a new super franchise similar to the MCU or maybe even Star Wars. These older franchises have been milked to death by now and the fans have been disappointed again and again. So just maybe it's time for a new kid on the block. And 40k could very well be this kid. And besides this pretty speculative thesis, the company is also growing quickly and is financially pretty strong with huge margins. And now that I look at it, I might need to do an updated full analysis on them soon. Next and the second last company today is Chipotle. This is my favorite fast food restaurant and one that I visit every time I'm in the US. They also have a yellow mark here just because they have had many changes in the last year, starting with their CEO. And I just didn't have a deeper look at them in over a year now. They are known for the Mexican style and semi-healthy food, at least for fast food. They also have a strong digital platform and a loyal customer base. They could grow their locations pretty quickly over the last years, but mostly in North America. So there is still a lot of potential for worldwide expansion. The stock surged in 2024, but in 2025 it's been under pressure due to a softer same-store sales, tariff-related cost inflation and cautious consumer spending. But as I said, please take this one with a grain of salt because I didn't have a deeper look at them for quite a while. And this brings me to my last stock for today, which is Ferrari. I probably also don't need to tell you what they do. They are one of only a handful high luxury companies in the world with exceptional brand prestige that even lets them choose who is allowed to buy one of their cars and who isn't. Talking about moat and branding power. And because of this and their very wealthy customer base, they can pretty much ask any price they want for their cars. We can see this in that despite the US tariffs, they could still raise their prices by 10% and reaffirm their guidance for the whole year. The stock is up by around 15% over the last year and is trading close to their all-time highs. For me, Ferrari is my favorite top luxury brand. They are also paying a small dividend but could grow this dividend annually by an average of 20% over the last 5 years. So this is the first half of my watch list. As I said, I will show you the second half in my next portfolio update and it includes stocks from the tech, semiconductor healthcare sector as well as some mining companies. And that just leaves my plans for the coming month. As I didn't have much time last month, these are largely the same as for June. I did start with my research in alternatives to the S&P 500 though, and I found one very interesting ETF that could be a nice candidate. And it is none of the most obvious choices here. I will talk more about this when I make my decision. I am also still looking for opportunities with my smaller European positions and JD.com, and especially Dassault looks like a good candidate right now. And if you're following these portfolio updates, you might know that in the last month I have bought heavily into Novo Nordisk. If you would like to know why, check out my full analysis on them right here. And as always, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching, guys, and see you in the next video.